Imagine turning a small investment into a fortune simply by reinvesting dividends. It's not a fantasy. It's how 82% of S&P 500 dividends are used, creating a wealth-building machine that never sleeps. Want to unlock the secret weapon of the financially savvy? In the next few minutes, I'll show you how to harness the explosive power of dividend investing. From real-world success stories to battle-tested strategies, you'll discover how to build your own passive income empire. Ready to transform your financial future? Let's dive in. Dividend investing is a powerful tool that can help you generate passive income streams and build lasting wealth. Imagine earning a steady income simply by holding shares of well-established companies. This is the magic of dividend investing. By choosing the right stocks, investing dividends, and allowing your investment to grow over time, you can achieve financial freedom and a comfortable retirement. Dividend investing involves buying shares in companies that regularly pay out a portion of their profits to shareholders in the form of dividends. These dividends can be reinvested to purchase more shares, creating a compounding effect that can significantly boost your wealth over time. Whether you're just starting out or looking to enhance your current investment strategy, understanding how dividend investing works is crucial. So, let's get started and explore the potential of this powerful investment strategy. Starting as a beginner, dividend investor can be daunting. One of the first challenges is choosing the right stocks. With thousands of companies to choose from, how do you know which ones will provide reliable and growing dividends? Another challenge is understanding dividend yield. A high yield might seem attractive, but it often comes with higher risk. You might also wonder how much to invest and how often to reinvest your dividends. These questions can be overwhelming, but don't worry. By the end of this video, you'll have a clear understanding and actionable strategies to start your dividend investing journey. Now, one common challenge new investors face is identifying companies with sustainable and growing dividends. After all, not all high-yield stocks are good investments. Some companies might offer high yields because their stock prices have dropped significantly due to underlying business problems. Investing in such companies can lead to financial losses if the company cuts its dividend or worse, goes bankrupt. Another challenge is managing your expectations. Dividend investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. Many people get discouraged when they don't see immediate results and give up before their investments have had a chance to grow. This is a problem I had when I started my dividend journey. Understanding that dividend investing is a marathon, not a sprint, is crucial to staying committed to your financial goals. It's one of the biggest lessons I've learned. Additionally, the terminology and metrics associated with dividend investing can be confusing. Terms like dividend yield, payout ratio, dividend growth sounds like jargon, but they are essential concepts to grasp if you want to be a successful dividend investor. Don't worry, I'll break these terms down and explain them in simple, easy-to-understand language. Now, let's turn to how to select individual stocks. Well, there are several key metrics to consider. First, the dividend growth rate. Look for companies that consistently increase their dividend payments. A steady growth rate indicates a company's financial health and its commitment to returning profits to shareholders. Companies that regularly increase their dividends are often financially stable and have a history of strong performance. This growth can significantly enhance your returns over time, especially when dividends are reinvested. Next, the payout ratio. This is the percentage of earnings a company pays out as dividends. A lower payout ratio suggests that the company retains enough earnings to invest back into the business, ensuring sustainable dividend payments. Companies with a high payout ratio may be at risk of cutting their dividends if their earnings decline. Ideally, look for companies with payout ratios below 60%, as this indicates a balance between rewarding shareholders and maintaining growth. And finally, company stability. Invest in companies with a strong track record of stability and profitability. Blue-chip companies, known for their reliability and established market presence, often make excellent choices for dividend investors. These companies have weathered economic downturns and continue to generate profits, making them reliable sources of dividend income. To illustrate these points, let's look at some real-life examples. Take Procter & Gamble, for instance. This company has been paying and increasing its dividends for over 60 years, earning it a place among the elite group of dividend kings. Such companies offer not only consistent dividend payments, but also the potential for capital appreciation. Procter & Gamble's commitment to returning profits to shareholders, coupled with its strong market position, make it a solid choice for dividend investors. Another example is Coca-Cola. Known for its iconic brand, Coca-Cola has a long history of paying dividends. Investors who bought Coca-Cola shares decades ago and reinvested the dividends have seen substantial growth in their investment. This is the power of compounding returns. By consistently reinvesting dividends, investors can purchase more shares, which in turn generate more dividends, creating a snowball effect that accelerates wealth accumulation. Now, let's dive into the top strategies to dominate dividend investing. First, the dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. Investing in dividend aristocrats can provide a stable and growing income stream. These companies have demonstrated their ability to maintain and grow dividends through various economic cycles, making them reliable sources for long-term investors. Examples of dividend aristocrats include Johnson & Johnson, 3M, and McDonald's. Next, the dividend kings. Going a step further than dividend aristocrats, dividend kings are companies that have increased their dividends for at least 50 consecutive years. These companies are the epitome of stability and reliability. They have proven their ability to generate steady cash flow and reward shareholders through thick and thin. Companies like Procter & Gamble, Colgate-Palmolive, and Lowe's are part of this elite group. Investing in dividend kings can provide peace of mind, knowing that these companies have a strong commitment to maintaining and growing their dividend payouts. The third strategy is dividend reinvestment plans, or DRIPs. DRIPs allow you to reinvest your dividends to purchase more shares automatically. This strategy accelerates the compounding effect as you're consistently buying more shares without additional capital. Many companies offer DRIPs directly to shareholders, often with little or no transaction fees, making it an efficient way to grow your investment. By reinvesting dividends, you harness the power of compound interest, which Albert Einstein famously referred to as the eighth wonder of the world. The final strategy is dividend ETFs. If picking individual stocks feels overwhelming, consider dividend-focused exchange-traded funds, ETFs. These funds pool together dividend-paying stocks, offering diversification and professional management. ETFs like Vanguard Dividend Appreciation ETF focus on companies with a strong track record of dividend growth, making them a solid choice for long-term investors. Investing in dividend ETFs can provide exposure to a broad range of dividend-paying companies, including the risk associated with individual stock selection. Now, let's bring these strategies to life with some real monetary examples. Suppose you decided to invest $250 a month into a dividend ETF with an average annual yield of 6%. Here's how your investment could grow over different time horizons. In 10 years, here's how your investment grows. With an initial investment, $250 per month, an annual yield of 6%, total contributions equal $30,000. And the future value of your investment is approximately $40,618. In 20 years, with the same $250 per month and 6% yield, your total contribution equals $60,000, and the future value rose to $113,360. Now let's look at 30 years. Again, assuming a $250 a month investment at 6% yield, your investment amount to $90,000 and the future value of approximately $243,628. These figures illustrate the power of compound interest and reinvested dividends. Over a 30-year period, your modest monthly investment of $250 grows to over $243,000. This is the magic of long-term dividend investing, small, consistent contributions that can lead to significant wealth accumulation. But wait, if this isn't impressive enough, let's consider the S&P 500's average annualized returns. Over the last 10 years, the S&P has returned an average of 12.6% annually. Over 20 years, the average return is 9.9%, and over 30 years, it's 10.5%. Now, when you add 6% dividend yield to these returns, the potential for wealth creation becomes amazing. Let's combine these returns with our $250 monthly investment. In 10 years, using the S&P return of 12.6 and a 6% dividend yield, that's a total return of 18.6% with a future value of approximately $78,597. Now let's look at 20 years. The S&P 500 average was 9.9%. And when we add the 6% dividend yield, it equals a total of 15.9% and has a future value of approximately $365,487. That's a lot of money from a modest $250 per month investment. But wait until you see what happens after 30 years. When you factor in the effect of compound dividends plus the average annual S&P returns, the result is nothing short of remarkable. Look at these numbers. Using the average S&P return over 30 years of 10.5% and adding the 6% dividend yield, you have a total return of 16.5%. What's the future value? An amazing $1,876,622. Let that sink in for a minute. Ask yourself, how hard would it be for you to invest $250 a month or a little more than $8 a day to amass almost $2 million? If you're 35 years old and start your monthly investment today, you could retire at 65 with a substantial retirement nest egg. And by the way, if you're fortunate enough to have a 401k at work and your own Roth IRA, then let's face it, you'll have nothing short of a luxury retirement. These returns highlight the immense potential of combined capital appreciation with reinvested dividends. Over 30 years, your $250 monthly investment could grow to nearly $1.9 million. This incredible growth showcases the power of long-term investing and the compounding effect of reinvesting dividends. Let's look at a case study of Ronald Reed, a janitor and a gas station attendant who amassed an $8 million fortune through smart investing, including individual stocks. Despite his modest income, Reed consistently invested in high-quality, dividend-paying stocks, reinvesting the dividends and allowing his wealth to grow over time. His story is a testament to the power of patience, discipline, and the magic of compounding. Ronald Reed's investment portfolio included well-known companies like Procter & Gamble, J.P. Morgan Chase, and General Electric. By focusing on blue-chip stocks with a history of paying and increasing dividends, Reed built a substantial nest egg that provided financial security and a legacy for his heirs. Another inspiring example is Grace Groner, a secretary who turned a $180 investment into $7 million. Groner bought 3 shares of Abbott Laboratory in 1935 for $60 each. She held on to the shares, reinvested the dividends, and watched her investment grow over decades. By the time she passed away in 2010, her investment had grown to millions of dollars, which she bequeathed to her alma mater, Lake Forest College. Groner's story highlights the importance of long-term investing and the power of reinvesting dividends. Dividend investing is a proven strategy for building wealth and securing a stable retirement. By focusing on companies with a strong track record of dividend growth, a sustainable payout ratio, and overall financial stability, you can create a reliable income stream. Remember, the key to success is a long-term perspective. Allow your dividends to compound over time, and you'll see your wealth grow exponentially. The examples of Procter & Gamble, Coca-Cola, Ronald Reed, and Grace Groner demonstrate with patience and smart investing, you too can achieve financial independence. Dividend investing is not just about picking the right stocks. It's also about maintaining discipline and staying committed to your investment strategy. Regularly reviewing your portfolio and staying informed about the companies you invest in and being patient during market fluctuations are essential practices for successful dividend investing. By reinvesting dividends and allowing your investments to compound, you significantly enhance your wealth over time. To recap, we've discussed the fundamentals of dividend investing, key strategies for selecting dividend stocks, and real-life examples of individuals who have achieved significant wealth through this approach. We've also provided a concrete example of how modest monthly investment can grow over time with the power of compound interest and reinvested dividends. Now is the perfect time to take action. Whether you're just starting out or looking to enhance your current investment strategy, dividend investing offers a path to financial independence and a comfortable retirement. Stay disciplined, keep learning, and watch your wealth grow. Oh, and one more thing. Remember our true story about Ronald Reed? Click this video to learn the details about his remarkable investment success on a low salary.